This is a real company's income statement. Redline Performance Group, a mid-sized parts manufacturer. Not a textbook template, they're actual numbers, and every line ties out. By the end of this video, you'll read any income statement top to bottom. Here's the whole idea in one sentence. You start with everything the company sold, then subtract its costs in layers, until what's left at the bottom is profit. Sales at the top, profit at the bottom. That's why they call it the bottom line. Let's walk down it together, one line at a time. Start at the top. Revenue, the top line, is everything Redline earned selling parts this year, $148 million. One thing that trips people up, revenue is what the company earned, not necessarily the cash it collected. Ship parts in December, get paid in February, and that sale still counts as this year's revenue. Hold that thought. It matters a lot later. For now, revenue is the starting point, and every line below it is something we subtract. The first thing we subtract is the cost of goods sold, COGS. The direct cost of making the parts, the steel and aluminum, the factory labor, the machine time. For Redline, $104 million. Subtract it and you get gross profit, $44 million. Now the useful part. Divide gross profit by revenue and you get gross margin, about 30%. That's how much of every sales dollar is left after paying to build the product. 30 cents on the dollar, before any of the cost of actually running the company. Gross margin is the first health check on a manufacturer. Next, we subtract the cost of running the business, operating expenses. 3 pieces. SG&A, selling, general and administrative, the salespeople, the offices, the back office, $19 million. R&D, designing new parts, $2.5 million. And depreciation and amortization, $4 million, which is a little different, so stick with me. When Redline buys a machine, it doesn't expense the whole cost in 1 year. It spreads that cost across the machine's useful life. That yearly slice is depreciation, a real expense, but no cash leaves this year. The cash left when they bought the machine. Remember that too. Subtract it all and you get operating income, $19 million. The profit from the actual business, before financing and taxes. About 13% of revenue, the operating margin. Now the term you'll hear more than any other, EBITDA, earnings before interest, taxes, depreciation, and amortization. In plain terms, take operating income and add back that depreciation slice, because no cash went out for it. For Redline, $23 million, about 15.5% of revenue. People love EBITDA because it's a quick read on the core business, without the noise of how it's financed or taxed. But one honest warning, EBITDA is not cash. It deliberately ignores interest, taxes, and the money spent on equipment. A useful number that's also easy to hide behind. We'll come back to that. Almost at the bottom, 2 more subtractions. Interest expense, $7 million, is what Redline pays to borrow money, the cost of its debt. Subtract it and you get income before tax, $11.5 million. Then the government's share, the tax provision, $2.5 million, about a 21% rate. Subtract that and what's left is net income, $9 million. This is the profit that actually belongs to the owners, after everyone else, suppliers, employees, lenders, the tax authority, has been paid. So read the whole statement as a story of 4 margins. Gross, 30%. What's left after building the product? Operating, 13, after running the business. EBITDA, 15.5, the core earnings shorthand. And net, 6%, what finally lands for the owners. Each layer strips out another kind of cost, and each one tells you something different. A healthy top line with a thin bottom line means the money is leaking somewhere in between. And now you know exactly where to look. One last thing, and it's the reason this matters. Redline's income statement looks great. Record revenue, 9 million in profit. But that same year, the company nearly ran out of cash. How can a business be this profitable and still be in trouble? Because, remember, revenue isn't cash, and profit isn't cash. The income statement can't show you that. The cash flow statement can. That's the next video. And if you want to see this exact statement land on a real CFO's desk the night a cash crisis becomes visible, that's part 1 of the main series. You can now read an income statement top to bottom. The next step is learning what it doesn't tell you.